So oftentimes I like to talk about some of my favorite stocks to invest in long term, but a lot of those tend to be higher priced stocks in terms of their individual share price. Now, that obviously doesn't mean that they are necessarily overvalued or undervalued, but they just kind of trade for high share prices. And so a lot of times I get comments from people saying that they wish that I would talk about stocks that trade for lower share prices because maybe their weekly or monthly investing budgets are a bit too low for them to afford those stocks at that time, and therefore it's a little bit harder for them to enjoy some of my videos. Well, fear not, because Robinhood has just announced that they will be adding fractional shares to the platform. It should already be rolling out to some customers. And if you're not familiar with fractional shares, basically you can buy a stock for whatever amount of money you want. So if a stock trades for like $1,000 and you only want to buy $100, you can just pay like $100 and Robinhood will break off a piece of that stock and give you whatever is worth the amount of money that you paid. And because I know that a lot of my viewers actually use Robinhood, I thought it would be fun to, in today's video, talk about my top 5 favorite stocks that trade for more than $200 a share for the long term. Now, the market is trading at record highs right now, so valuations are pretty high just kind of across the board. So we're going to focus more on the future potential of these companies, which I do really believe in for the long term. And we'll do kind of a rapid fire, and I actually own a lot of these as well myself. So I'll probably be utilizing fractional shares over the years to buy on any like dips and things like that. So anyway, I think this should be a fun video though. And if you guys enjoy this and you want a part 2 where we can take a look at maybe some stocks that trade north of $100, so maybe like $100 to $200 per share, and there's a lot more stocks that we could look at in that range, let me know down in the comment section or just by hitting the like button. But either way, I hope you guys enjoyed this video, and with all that said, let's go ahead and start with stock number 5. Okay, starting things off here with stock number 5, we're actually going to count down from 5 down to 1, and we're going to go from the lowest share price to the highest. But again, all of these are above $200 a share. Okay, starting with stock number 5, that's going to be my favorite Chinese company. And no surprise here, you guys know this one, I talk about it pretty often. But this is the Chinese e-commerce giant known as Alibaba, ticker symbol BABA. And they do actually trade north of $200 a share. Now, I will just add that they are technically planning on doing a stock split, so the share price will come down, but I think they can technically wait until like June of 2020 until they actually do that. So it could be a while until we see the share price come down. So in the meantime, fractional shares could be utilized, and I may actually use them myself because this is actually a stock that I do currently own. Now, this is actually a fairly new position for me as I started buying them for the first time ever around the start of 2019 when most Chinese stocks were getting completely destroyed, and Alibaba just stood out to me as the best option among them. That's because they're the market leader in 2 very large and very important markets in China, those being online shopping and cloud computing. In the e-commerce market, they control over 50% of it, with the next closest competitor in second place being JD.com at only 16%, while third, fourth, and fifth drop all the way down to just 7%, 3%, and 1% respectively. And I don't really see any of those as being a major threat to Alibaba other than maybe JD.com. But again, they're much smaller in terms of market share, and they really operate in a different way as well, as they try to sell and or deliver most of the products themselves, while Alibaba takes much less accountability into their own hands, which does lead more frequently to the occasional fraudulent seller or defective product, but it also helps reduce costs and improve profitability. In fact, when looking at net income in their last fiscal year, Alibaba brought in over 87 billion yuan, which is the Chinese currency, versus JD, who was actually negative. Either way, Alibaba's e-commerce business is thriving, and it should continue doing so given that online sales in China continue to grow north of 20% a year while still making up less than 20% of total retail. In other words, there's still plenty of room to grow even for the most dominant players. And just like Amazon, Alibaba has a huge cloud computing business that controls even more market share than Amazon in the Asia Pacific region, and still managed to grow by 64% in their last quarter, which is obviously huge growth for an already massive platform. These 2 businesses, along with several others like their 33% stake in Alipay, which has by far the most digital payment users in the world at over 1 billion people, are helping Alibaba remain one of the largest and most dominant companies in China, yet they continue to grow at very impressive rates of over 50% a year during a time when China's economy has been really struggling greatly and has seen its worst growth numbers in nearly 3 decades. Granted, some of that is looking like it's spilling over into Alibaba's business, as their sales growth is expected to slow down to 38% this fiscal year and 29% the year after. But given that it seems like progress is being made on a trade deal between the US and China, there could actually be some room for surprise to the upside if the Chinese economy improves. Either way, Alibaba is definitely not a stock without its risks. Make sure you watch my Before You Buy Chinese Stocks video for more information on that. But over the long term, this could still be a pretty decent stock to invest in, especially in small amounts, maybe using fractional shares if necessary through the coming years. All right, guys, moving on to stock number 4, we've got my personal favorite semiconductor company. Out of all the semiconductor ones out there, this is my personal favorite for the future. And this is a company known as NVIDIA. Ticker symbol is NVDA, which currently trades for over $220 per share. And this is also another stock that I do currently own myself. And just like Alibaba, NVIDIA is also a relatively new position for me that I started buying around the start of 2019 when it was crashing heavily to around $120 a share. But since then, the stock has climbed by over 80% from those lows and is so far up by close to 70% year to date. I'm only up around half of that amount myself because I actually bought at several different price points, but it's still been a really well-performing stock for me nonetheless. In any case, I do still think that NVIDIA has a pretty bright future ahead of them, given that they compete in several different markets that I think will see very high growth over the long term. These include autonomous driving, gaming, high performance computing, the Internet of Things, smart cities, cloud computing, and especially artificial intelligence. See, NVIDIA is a semiconductor company that develops and sells really powerful graphics processing chips that will likely power many of these industries. When looking at autonomous driving, NVIDIA already has over 370 different partnerships ranging from self-driving cars and semi-trucks to mapping software and detection sensors. In PC gaming, NVIDIA is often considered the most powerful choice amongst its peers for superior graphical performance, and they usually command the most market share to go along with it. And they've been the first company to really push ray tracing technologies as well, which is something that really brings video games to life and makes them look much more realistic, and is actually growing in popularity despite its very weak start. When looking at the Internet of Things and smart cities, it's my belief that over the next few decades, you're going to see many more devices be connected, and artificial intelligence will make cities run both smarter and safer through the use of many sensors that will capture large amounts of data. And that's where NVIDIA will likely shine, as their GPUs will be some of the fastest and most efficient chips in the market to process all of it, given that they continue to break new performance records every year. And to give you some context on the market potential, Allied Market Research estimates that the smart cities market will be worth trillions of dollars in just a few years from now, so this could be a huge opportunity for NVIDIA. And much of that will likely be integrated in some way with cloud computing, which NVIDIA estimates that their total addressable market for the data center will be worth $50 billion in just a few years as well. For context, they only did about a fifth of that in total sales last year, and only about $3 billion of that was even from the data center. But while we're on the subject of sales, I'll just quickly mention that they're struggling a bit this year because of the cryptocurrency crash and resulting hangover, but once they recover, they should return to growth rates of nearly 20%, and that's been helping propel the stock back to higher levels. Again, NVIDIA is definitely a company that I believe in long term. I do, however, already have most of my position built out in the stock that I wanted to have, but with the addition of fractional shares, I think I would actually be willing to add a little bit to my position, especially on any significant dips. Okay, and that brings us to stock number 3, and there's no way that I could have done a video about stocks that trade north of $200 a share without including this one. This is one of the most popular stocks out there, and of course, you guys know who I'm talking about. That is Tesla. Ticker symbol is TSLA, which does actually trade at over $360 a share. And as you guys know, this is actually a stock that I do own myself, but it's actually an even newer position than both NVIDIA and Alibaba, as I started buying them around halfway through the year when they were crashing very hard. I think I first bought this stock around 240 or so, but they eventually crashed all the way down to less than $200 a share, and that's when I really started to accelerate my buying. But since then, they've been on a tear, climbing by over 50% in just the past 3 months alone. In any case, I still think that Tesla has a bright future ahead of them, given that they have so many things going right for them at the moment. Despite auto sales completely plateauing for years now, Tesla has been able to grow their deliveries at very high rates increase thanks to the rise in popularity of electric vehicles. In fact, through the first half of 2019, Tesla grew their deliveries by over 65%, while most other major auto manufacturers actually saw significant declines. Even more recently, the Model 3 continues to be the best-selling vehicle in its class, while also taking the third top spot in America when including much cheaper vehicles with nowhere near the same type of technologies or performance. And for the full year, Tesla had previously guided for 360 to 400,000 deliveries, so the midpoint of that would put them north of a 55% increase, which is obviously very good. And the result of all of this success has been huge revenue growth rates in each of the past 3 years. To be fair, that growth is coming down significantly both this year and the next, but a lot of that can likely be attributed to their new structure with leased vehicles where they account for the sales over longer periods of time, the shift away from much higher priced vehicles like the Model S and the Model X in favor of the much cheaper Model 3, and the fact that they're focusing more on cost cutting right now in preparation for their next surge in growth that will likely come from the Model Y that may also be cannibalizing some of their sales at the moment, even though I think it's more of a production kind of constraint, I guess, than anything else. But the new gigafactories in China and later Europe will likely help with all of that in a major way, as well as improving profitability, which is also a very big deal. But going back to the Model Y crossover SUV, that'll likely sell even more than the Model 3, considering that it's the largest vehicle segment in the world, while the cost-cutting efforts are leading to an explosion of profitability, as they're expected to average EPS growth of over 100% over the next 5 years, while some of their competitors like Ford and GM are both expected to see declines. And over the longer term, there's still other catalysts to look forward to, like an autonomous robotaxi service that will target a market worth trillions of dollars in the future, the Tesla Cybertruck that already has over 250,000 reservations and will target the second largest vehicle segment in America, the Tesla Semi that has already been ordered by giant companies like UPS, PepsiCo, and Walmart, and will also be targeting an enormous market around the world. And on top of all of that, they still have their energy segment that will compete more heavily in the energy storage market as time goes on, which is set to grow deployments by over 1,000% over the next few years. Needless to say, Tesla has many different growth levers they can pull in the future, and it's just one of those companies that is absolutely on fire right now, and that's led to a pretty high individual share price. So using fractional shares over the coming years may be a good option for those with smaller budgets that want to be invested in the electric vehicle company. Alright guys, moving on to stock number 2. This is actually a stock that I do not currently own myself, but it's definitely one that I want to pick up in the future, especially on any dips. However, the only problem with this stock is that it currently trades for over $1,000 per share. So I'll probably have to use fractional shares myself just to buy into this one, because I like to buy in small amounts, especially when I initiate a new position. But that company is of course Alphabet. I just call them Google. Ticker symbol is GOOG, and they currently trade for over $1,300 a share. So it's a pretty high share price. But over the long term, I just can't really think of much that will keep them from outperforming. And that's because they control over 92% of the internet search market with Google Search, 64% of the internet browser market with Google Chrome, and 75% of the smartphone OS market with Android. Not to mention, Gmail and Google Maps. Those are really market leaders in their own respective markets as well. All of which are collecting enormous amounts of data, and that coupled with the platforms themselves, including YouTube, which you happen to be using to watch this video right now, has attracted a gigantic amount of advertisers to Google for their very well targeted ad placements, and thus led to them being the market leader in digital advertising in what is essentially a duopoly with Facebook, in what is also a market that will only grow larger and larger in the future. But the good news for Google is that it will be very difficult for other companies to convince advertisers to leave the Google brand, considering that Google is considered the second most valuable brand in the entire world according to Forbes. And that means that advertisers will not only continue to use Google, but that they'll likely pay a premium for that privilege. But another thing that all of their data is useful for is of course artificial intelligence. And it's my belief that Google will likely fuel much of the AI of the future, and they're already finding creative ways to use data as they have a number of AI subsidiary companies like Verily, Calico, and DeepMind, all of which are using AI to improve healthcare among a number of other uses. There's also Google Assistant, which is expected to steal more market share than virtually all other digital assistants combined in the entire world, according to Statista, even ahead of Amazon's Alexa. And they have their own autonomous driving company in Waymo that has already launched a robotaxi pilot with over 100,000 rides to date. And they even have the third largest cloud computing platform in the world, only behind Amazon and Microsoft, yet they're actually growing at a faster rate than either one of them, which is very impressive. All of that has led to unbelievable performance over the years, as they did over $136 billion of revenue last year and are still growing at around a 20% clip. And profits are equally impressive. Again, they have high margin advertising sales, as they did over $30 billion of net income last year, which was up from $12 billion the year prior, and are still expected to grow their EPS by a double-digit percentage on average over the next 5 years. So again, Google is this giant company that I think will only get bigger in the future, and I would love to own the stock myself. By the way, this whole time I've been referring to them as ticker symbol GOOG rather than GOOGL. They both trade about the same, but if you care more about voting rights, then go with GOOGL. Otherwise, there's not really much difference. Okay guys, and that brings us to the final stock of the video. And no surprise here, I think you guys would absolutely murder me if I did not include this stock in a fractional shares video. And that's of course GoPro. Ticker symbol is GPRO. They trade at around $4 a share. I'm just kidding. The final stock on the list is obviously Amazon. Ticker symbol AMZN, which trades north of $1,700 a share, and they've actually traded north of $2,000 not too long ago. And tell me something guys, how many of you are not currently invested in Amazon, but you probably would be if you had access to fractional shares? Because I get so many comments from people telling me that they love the company, but their budgets on Robinhood just haven't allowed for them to be spending like $2,000 on an individual share. Well, the good news is that pretty soon you'll be able to own Amazon too. Now, the stock has climbed by close to 500% over the past 5 years. And as you guys know, I've been buying this stock for years now with a cost basis of around $1,000, but it's currently my second largest position in my entire portfolio. So I'm not exactly eager to add more at this time, even though I do still think that they have a very bright future. But I did actually add some more not too long ago. But either way, this year alone, they're expected to do pretty close to $300 billion in sales, which is already an astronomical number to think about, yet they're still growing at around 20% a year. That's pretty crazy. Now, the stock pulled back a little recently because Amazon is once again focusing more on reinvesting their profits rather than just growing their EPS, which has led to many analysts slashing their earnings growth estimates, and the stock has corrected down a little as a result, but I think a lot of the negativity may be overblown. See, Amazon is investing heavily on free one-day shipping for Prime members, as well as expanding their warehouse footprint and product selection. But while Wall Street is criticizing them for the moves, they're conveniently forgetting that recent results are already showing that the investments are starting to pay off. In their last quarter, their online store sales actually grew by a massive 21%. That's much higher than the typical low teens growth that they usually see in that segment. And keep in mind that Amazon already controls nearly 40% of the US market, so it's not exactly normal for them to be able to grow that segment north of 20%. In fact, in the earnings release, Jeff Bezos, the CEO, commented on the recent investments, calling them the right decision for their long-term strategy, as customers are loving the faster speeds and have already ordered billions of items with the new delivery option. I happen to agree with Bezos, as it's becoming harder and harder for virtually any other company to compete with Amazon at this point, not just on prices, but also on delivery and convenience. And keep in mind that this new speed is only free to Prime members, and that's ultimately the long-term goal, is to get as many people hooked product on Amazon Prime as possible so that they can generate even more recurring revenue. For context, it's believed that over 80% of US households already use Prime, and the last time that Amazon told us how many subscribers they had was back in April of 2018 when Bezos revealed that the number had climbed to over 100 million members, but he was actually referring to 2017, so that number is likely much larger now that we're entering 2020. That's a huge deal because according to Business Insider, the average Prime member spends more than double the amount of money per year on Amazon's website than the average non-member. So anything that Amazon can do to not only grow their subscriber count but also keep them happy and loyal to the brand is incredibly important for long-term success. But speaking about the long term, there's actually still a lot of room for Amazon to keep growing in several different markets in the future. For example, they're only the third largest digital advertising company by market share, but are actually growing faster than both Google and Facebook while having a lot of market share to steal, while those have a lot of market share to lose. And in their last quarter, Amazon grew that segment by a whopping 44%. They also have by far the largest cloud computing platform in the world at over 30% market share, yet they're still growing that segment at north of 30% each quarter as well, which is really impressive. Granted, other companies are growing faster, but given that cloud computing will likely get much larger over time, especially with the rise of AI, the Internet of Things, and the general trend of everything going digital, there's really not much reason to see AWS as anything but a huge asset for them over the long term. And speaking of AI, Amazon even unveiled a new data center chip recently that is estimated to be around 24% more powerful than Intel's and be built on a 7 nanometer process while Intel is still on 14. Amazon has become so disruptive over the years that they're even trying to break into the trillions of dollars healthcare market and have even thrown some leftover cash at Rivian, which is an EV startup with ambitions of competing with the likes of Tesla. And that's just normal business for Amazon. While everyone continues to complain about the valuation, which I actually do agree with, the valuation is very high, but Amazon doesn't really care about that. They just continue to disrupt markets and find new ways to grow and get bigger and bigger over the years. I've said it before and I'll keep saying it. I wouldn't be surprised if Amazon becomes the first company with a $2 trillion market cap in the stock market. Of course, anything can happen, but over the long term, I don't think I would bet against Amazon. Anyway, I think that just about does it for today's video. What did you think about my 5 favorite stocks that trade north of $200 a share? Are there any that I left off the list that you would add to it? And if so, which stock would you remove for the list? Don't just tell me which one you would add, because I can't just make super long videos. Let me know which stock you would remove. These type of comments help influence future videos, so I really do read them and take them into consideration. So let me know down in the comment section, and if you enjoyed the video, please consider hitting the like button. Really helps support the channel, and I appreciate all the support, guys. Thanks for watching. Take care. Bye-bye.